Hello.
Morning, Doug. Good morning, Peter.
Good morning, Samson. Good morning, Doug. Doug, I think we should remove you from the.
Doug can stay if he'd like. I'd love talking to Doug. He can help us kick off the introduction to everyone.
I think that's
As
fine.
You can put me
he's an
back in
OG
the
in the
waiting room
space.
for all I care.
Okay. All right. So, Samson, I'm going to hand the floor over to you to introduce the conference here. I see that all the speakers are, for some reason, coming up to the up. So that's maybe not what we need right now. Sorry about any confusion. I'm going to put you folks down in the.
I'm waving at Darshan.
Hi, Steve.
Hey, Doug, how are you?
Okay.
Good. I'll catch up with you when I get a minute. Apologies.
I'm looking forward to it.
Yeah.
You set the world afire with all your bloody SPACs.
I tell you.
Steve, Doug, I think I should turn off our cameras for a moment. Let Samson do the presentation. So
Okay.
I'm just going to give a quick intro for everyone. Oh, can you hear me? I feel like we're live for some reason. There we go. I love technology. It always works when you don't want it to work, and it never works quite like you want it. So at any rate, I feel like we're live. So welcome to the Crowdfunding Professional Association Summit. Good morning, Trevor. Glad you could join us this morning, as well as everyone else here. We're going to have a really good overview of the state of crowdfunding, not only from March of 2021, when our new rules went into effect, but also everyone else. I see Scott is dropping in some notes. Scott, if you feel free to join me here on the stage so you can discuss this with me over the next couple of minutes as we give this introduction. So I just want to level set things for everyone. Starting this Crowdfunding Professional Association, we've been diligently working with our strategic partners at the SEC, at FINRA, and across the regulatory space to help improve the state of crowdfunding for everyone. As you all know, we were able to successfully advocate for the raises to go through from 1 million to 5 million and from 50 million to 75 million in the Reg A Plus world. In addition to that, there's also some other great changes that happened in the testing of waters and the blue sky rules. And of course, we're constantly working on how can we better, as an industry, improve the ecosystem, not just for portal owners, but also for investors, broker dealers, and the larger ecosystem as a whole. So, in that note, if you have any questions or suggestions for the Crowdfunding Professional Association of how we can improve the ecosystem, let us know. And I see here we're joined by Scott McIntyre, the chairman of the board. Good morning, Scott.
Good morning, Samson.
Before I drown on and bore the folks with some data points about how many jobs the Jobs Act created in 2020, what is the message that you want the audience and the participants to take away from today?
Oh, there's so many messages. I've prepared kind of an opening statement, and I think we have 7 or so minutes. I can read through it if that would help.
Go for it.
Yeah, I was actually going to try. I recorded it, and I want to see if we can play it. We had some issues with audio, but let's see if we can't get a screen share working really quick. And I'll just let it roll. Hold 1 second.
Excellent. So while Scott is getting that up, I just want to say that in 2020, over 33,000 jobs were created using crowdfunding, using Reg CF, using the Jobs Act. And so for me, that is personally the reason I wake up every day. I'm excited to be part of the Crowdfunding Professional Association because we're getting Main Street back to work. Main Street never left working. We're empowering Main Street to work better, faster, harder, and more efficiently in entrepreneurs' pursuit of the American dreams. So Scott, do you have your video up?
I do. Let's give it a try. I just need to
Excellent.
be able to share. And I think I've got screen 1 ready to go. Let's give it a try. Let me know if.
Nope, I don't hear it, Scott. So you're going to have to just read it to us.
Wait for it.
Scott.
chairman of the CfPA, and I want to welcome you to Orlando. Virtual format. This year, it's on the subject of crowd investing. My 2020 address celebrated God and endurance, characteristics of leadership at the CfPA during what was a challenge. Having secretary.
Hey, Scott.
Scott, just read it.
Hey, Scott, if we can just hit pause, we'll have to have you
Lost
just
it, huh?
speak off the cuff or read it because we can't actually see it.
Not a problem, my friend. So I'll just read.
Awesome.
Should we start from the top?
Start from the top.
You got it. Hello, everyone. My name is Scott McIntyre. I'm chairman, as Samson so graciously pointed out, of the CfPA, and I want to welcome you to our long-awaited and new virtual format annual summit this year on the subject of crowd investing. My 2020 address celebrated a few things. Guidance, faith, and endurance were the themes, as they are the most vibrant characteristics of leadership at the CfPA during what was a challenging year for pretty much all of us. And having served previously as committee chair, secretary, vice president, president, and now chair during all of the 9 years since our foundation, these key attributes are equally reflected on these same brilliant, generous volunteers that surround all of us at the CfPA, but more importantly now also describe the beneficiaries of all of our hard work, and to be fair, also the hard work of our representatives and regulators in DC and in every state that help make the new rules of the road more accessible to more of the job creators that crowdfunding empowers. My theme for today focuses on 3 points: resourcefulness, resilience, and respect. And while resourcefulness is perhaps most synonymous with entrepreneurship, I assure you that it's a mandatory attribute of nonprofit organizations like ours. Anyone fighting to make what was not before knows that while resources may be plentiful, finding them is always easier with a guide. And anyone who has endeavored to bottle lightning knows it's ultimately a battle of endurance. That's why I chose to emphasize resilience, the quality that must outlast resourcefulness, creativity, and of course even ego. But relevant to today's subject, at times it must also outlast capital, because failure is by far the most common result of entrepreneurship. Fortunately for us, if there's any characteristic common among Americans, especially our innovators, small businesses, and the self-employed, it is resilience. So if you've faced displacement recently, or rejection, or failure, or if you're finally just going for your big idea, you're at the right place. If you're looking for guidance, today's your day. So kind of reflecting on another subject, helping my 11-year-old son to write book reports this year, I told him how my training in journalism taught me to always cover the 5 W's: who, what, when, where, and why. But when organizing plans or telling stories, I later learned that it's an oft unmentioned H that matters most to investors, and that H is how. Because it occurred to me that learning more about these hows is what brought you and so many of our fellow entrepreneurs to the CfPA, and hopefully today for this summit as well. To learn from the mistakes of others, to gain insight from best practices, and to seek guidance that could launch you further faster. These hows are perhaps the most valuable asset a trade group can offer. So as you practice your new skills, test your new ideas, and ask for help from friends and strangers from the crowd, you will learn from and build communities new and old, near and far, some long-term friendships, others just alliances for the short term, some for profit, some for purpose. But I promise you above all else, and as I tell my students on day one, I'm just glad you're here, because 90% of success is just showing up. And while that's the last of today's keywords is respect, it's by far not the least. It's what we at the CfPA do every day out of respect. We work for you. We work for the entrepreneurs facing their fears. We work for the investors seeking their bliss. And we work for the economy seeking sustainability, all out of respect for the hard work that it takes to build new enterprise. For them, for you, we saw that the playing field was not level. The rules of the road were not fair. So the CfPA was founded with the mission to make more accessible paths to capital formation, to make more equitable markets for investors, and ultimately to make more rewarding what we all know is some of the hardest work in life, making something from nothing. So thank you all for joining us today. We hope to hear that you got what you came for, and we hope to see you join our mission at the CfPA as members, volunteers, and sponsors, so we can continue to build on the work of so many professionals in so many fields that make crowdfunding what it is today, the critical bridge from hard-fought savings of family and friends to the demanding nature of capital from private investors, in SAFEs, in SPVs, in SPACs, to bridging public markets with funds now attainable finally via the crowd with Reg A+. It is this continuity that I've cited for years as both a goal and a marker of success. That continuity and the fluidity of capital that supports it is vital to the liquidity that makes markets hum. And transparency, the ability to now track key metrics from a garage startup all the way to Wall Street, is a key function that several of our guest speakers will address today. So today's summit is designed to illuminate some of the good news about growth and development of crowdfunding, equity investments in particular, but it will also focus with bright lights the realities that issuers all face, the hard work ahead for many of you. More on those mechanics to follow, but one of the stats that struck me most in preparing for today's event was how evenly balanced the overall crowdfunding ecosystem has become, funding ventures big and small, far and wide, but mostly with the diversity of purpose that really touch every sector of our culture and our economy. I'll leave it to our dear friends Barry from the UK, Oscar from the Great North, Jenny from out West, and Woody, another one of our founders, to better detail some of this remarkable growth. But that one stat alone gives me pause to consider how far we've come in only 9 years, and despite a divided Congress, and what an impact crowdfunding has had on so many innovators, families, and communities. But also what it promises has yet to fulfill. Promises like certification of industry expertise, like qualification of accreditation instead of just quantification, like reality checks for issuers. These are important goals that are all on the slate this year at the CfPA, and we'd love to hear your voice in all of it. So before I wrap up, I want to make sure to thank all the soulful volunteers and leadership at the CfPA, from our new president, Samson, who you've already met, to our VP, Devin, to our polymath of our secretary, Brian, and to Sarah for her efforts to make this new industry safer for everyone. And of course, to our generous sponsors who make events like today's even possible for an all-volunteer nonprofit. I want to make sure to call out DigiBuild, who brings the historically opaque construction industry transparency and accountability through blockchain, and to CrowdCheck, which helps entrepreneurs avoid liabilities with disclosure and due diligence. Thank you so much for your expertise and sincerely for your vital support of the CfPA. And of course, the dozens of other volunteers, many of whom you will engage today or at any time on our expert community online, yet another tool of membership that pays dividends that you'll learn more about today from another one of our directors, Brian. All these people you can find at cfpa.org, where you expertise, reference their work, and even seek their professional counsel. So on a personal note, for any of you able to pledge a little time as a volunteer, let me assure you that without volunteering, I'd likely not have been able to address heads of state, leaders of industry, throngs of innovators, and tens of thousands of students. But trust me, it is the best investment you will ever make. And if you can afford only a few hours a month, you have a home here at the CfPA. Lastly, I'm compelled to pay respects to a dear friend who passed away since our last summit, a man widely known as the godfather of venture capital law, who inspired and challenged me as a mentor. In addition to the many years he graciously served on our board, and already well into his 70s when he joined us, to my dear friend Joe Bartlett, thank you again for all you gave. Your booming voice echoes still. With that, I will turn over the mic to our session hosts and look forward to engaging all of you at chat tables throughout the day. To your resourcefulness, to your resilience, thank you for joining us today. Respect.
Thank you very much, Scott. And just a order, we're going to, we have 2 tracks. Next up, we're going to have not only Sean and some other individuals talking about an investment advisor's perspective, but also we're going to be reviewing some crowdfunding success stories. So we have these 2 tracks. You can select which building you're in, and in between each of the presentations, I highly encourage you to double click on a table, join, chit chat with people, and get to know your colleagues. So without any further ado, I'm going to let you select which of the presentations you would like to attend, and we will see you and continue to engage with you all throughout the day. See you guys in the conference.
And now we would like to bring up to the speaker panel Darshan Kendrick and Doug Elenoff to speak about the investment advisor's perspective on crowdfunding. So I'm gonna let them introduce themselves and have a good panel.
Good morning.
Hi, Darshan. It's nice to meet you.
It's nice to meet you too. So I am currently here in the state of Georgia, in Lithonia, Georgia, which is about 20 miles east of Atlanta. And I'm a corporate securities attorney, have been that way for the last 13 years. I've helped companies with their legal compliance raise to the tune of $500 million. I work specifically with minority founders and female founders. And I'm also an investment advisor representative, have been for the last couple of years. I'm also a FINRA arbitrator, so I arbitrate specifically disputes between investors and issuing companies. And I am also a policymaker here in the Georgia House of Representatives, so I work closely with our securities laws and team down here in the state of Georgia. And we specifically have a crowdfunding exemption here in the state of Georgia that I'll tell a little bit about later that I think is very, very interesting. But that is me, and I'll turn it over to Doug.
Well, I actually remember when you created the first intrastate crowdfunding exemption in Georgia. So it's
My name's Doug Elmanoff. I've been practicing corporate securities law
for 30 years. I'm involved as a partner at a law firm in New York. We're 130 lawyers, and we've been involved in a series of alternative finance programs, including the establishment of crowdfunding, SPACs, PIPEs, registered directs, ATMs, and a whole, reverse mergers. And so it's a pleasure to be here today and talk with you, Darshan.
Yeah, absolutely. You know, I tell people one of the best kept secrets here in Georgia is our Invest Georgia exemption, or IGE. We don't have a lot of people who have taken advantage of it, unfortunately, and it's been in place since 2012, right after the Jobs Act. And we actually were one of the first states to go from 1 million to 5 million. So we've been at $5 million as the cap since 2017, even before the federal government caught up to us. And so, you know, I think Georgia is doing some interesting innovation, trying to provide access to capital, which is really one of my passions. And so I'm just out here trying to get as many people as possible to realize that there's not only federal crowdfunding, but check your particular state, because there might be some interstate crowdfunding initiatives and things out there as well. But Doug, you have been practicing law a lot longer than me, so I'm always interested to learn what has been sort of the change over with the way that people investing their money, how they're able to access capital markets. You seem to have a wealth of knowledge to just have seen that transform over the years.
Well, it's always more fun to speak to newer professionals who have maybe a more enlightened point of view than some of the old timers, quite frankly. Working on the crowdfunding rules with Vince Molinari, who spoke earlier, and Sherwood Neese and Sarah Hanks and all of the other early embracers of the program. What was eye-opening was to realize that even though from my perspective, inevitability and online capital formation was going to be a better way of approaching what had been friends and
doing it all down disclosure was going to be a more efficient
way of many more companies raising money and doing it in a way that many investors from around the country could participate in interesting deals. As Samson pointed out, I think 30,000 jobs have been created. It was controversial. It was Congress to make it law in order to force the securities regulators to permit it as a legal activity. And so it's very professionally rewarding after 5 years to see that much of the work that we had laid down in 2012 has been embraced and recognized, that the concerns voiced in particular by state regulators has not been borne out, and that there hasn't been a lot of fraud. In fact, if there had been, they would have never increased the caps from the 1 to the 5. Mm-hmm. So it's very good to see that all of the crowdfunding platforms have operated in such a responsible manner. And now that I think about it, I think the first Georgia intrastate deal was a guitar deal, if I recall.
Yeah.
But anyway.
Yeah, Georgia, of course, you may have heard that MailChimp was one of the first companies to use Georgia's intrastate crowdfunding exemption. And of course, they went on to do a Reg A, excuse me, not MailChimp, I meant Ground Floor, which is a real estate crowdfunding platform. They used IGE, and then they went on to raise 50 million under the Reg A regulations. So what I really appreciate about the federal and Georgia intrastate crowdfunding exemption is trying to give as much access to private markets as possible. And I tell people all the time, as a registered investor, that a lot of millionaires, if you read books on polling millionaires, a lot of them accumulated their wealth through private markets, through investing into private businesses. Everybody thinks millionaires make their wealth in the public markets, but a lot of millionaires get the majority of their wealth from private markets. And so making sure that that's accessible to as many people as possible, particularly Black founders and female founders, it's just so vitally important to make sure as many people are able to access those markets as possible. The SEC just finished updating their rules on who's an accredited investor, which I was happy to see. And so now there's a whole new class of people who qualify as accredited investors. And so hopefully they'll move in that direction, giving more people access to private markets. And like you said, nobody has been able to show me that there's this rampant fraud, sort of thing going on. So I think we are, in good hands with that so far. But we could always do more. And I'm not sure what your relationship is with the Securities and Exchange Commission, but I try to participate in their capital markets, small business committee meetings that they have. They're public. Anybody can attend them. So I always encourage people to go to sec.gov and sign up for the press releases, sign up for their e-newsletter, sign up for their notifications, because they have a lot of good free events. You're able to submit comments. And that's how you really participate in the policymaking process, right?
I love your energy. I love your orientation. Yes, what has happened as a result of crowdfunding is a lot of Americans who otherwise would have had no interaction with the Securities and Exchange Commission recognize that they can have a point of view and affect change. To your earlier point, what's great about crowdfunding, and it was evident from the beginning, was that it was going to help entrepreneurs of diverse background raise money more readily than they could otherwise in the traditional institutional markets. Your point is, which is a different take, which is is that investors of different backgrounds can now participate and create wealth for themselves. Nobody is suggesting that you can't lose money, because you can, right. But the private markets are a place where you can make a meaningful sum of money on your invested capital if you pick the right deals. And so what's important, and as an investment advisory lawyer, you know this better than I do, is you want to spend the time to get to know the companies that you might invest in. You want to make sure that they're on responsible platforms, that you don't lose confidence in a deal. Read the comments, poke around, and make sure that you're comfortable with the products and services that are being offered, the terms of the securities that are being offered before you make an investment. While it's fun and it's interesting, it's supposed to be about making money at the end of the day and supporting companies that you believe in.
Absolutely. And I tell people all the time that whenever you're talking about raising capital, there's always sort of two mindsets that you have to have. There's the regulatory side, where you're dealing with state agencies and things that you have to file, right? On the other side, there's the internal things, like having a private placement memo, having a pitch deck, and doing your research. So just because it's not required to be filed with the SEC or not required to be filed with a state regulatory agency, that there's not these other things that you should be looking at, the internal documents that govern how the company is going to be raised. So, to your point, it doesn't, while regulation crowdfunding definitely lowers the barrier to entry and use common sense and to do their own due diligence before they're making investments like that. But as I guess Adam Smith would say, it's good that you have all these this exemption and are able to put their businesses on platforms, because what it does is all this noise and competition, and so people have a point in order to get those investment dollars, and I think that just helps create a better private capital market for people who are trying to raise capital. The more people that know about it and the more people that get in the game, and so I'm excited to see what it is that 2021 is going to bring. Venture capital has done record levels in 2020. I'm always looking at PitchBook data, and I'm astounded by the number of money that was made during a pandemic. Of course, North American private markets have been doing extremely well as well. So there's money, seems to be money out there. So I just encourage entrepreneurs to just continue to offer something new into the market and really take advantage of this crowdfunding.
Right. I mean, we're creating an amazing ecosystem of farm team companies to go up the ladder of capital formation, from crowdfunding to private placements, whether it's Reg A plus, ultimately an IPO. It's very exciting to see all these companies. I went on many of the platforms yesterday just to see the deals and what's happening, and are they raising more money? And when you look at the macro statistics for the industry, we're on a clear trajectory. Just like 25 years ago, I didn't know that my SPAC market would become what it has become, which is an effective competitor to the venture and the private equity markets. But crowdfunding is going to be, while it's relatively small dollars, $500 million raised over the last 5 years, it is going to be formidable over the next 10 years. But what I'm also fond of saying, Darshan, which I'm sure you agree with, is just because you can do something doesn't mean that you ought to do something. If you're an entrepreneur and you want to raise money in crowdfunding, you are taking on a societal responsibility to take in investor dollars, and you darn well ought to treat that capital as you would any family members. You have to make sure you have a clear path and visibility as to what you want your objective to be, and you will not veer off that. You may not use it for personal gain or benefit. You have the public trust in your hand, and you have to use it very responsibly, because just as supportive as the crowd can be, if you don't do it properly
to the markets,
because they will be ruthless with you. And that's what really has helped police it in a very effective way. And so for me, the last 5 years has just been incredible to watch. And I'm so proud of all of the entrepreneurs and the crowdfunding platform owners, sponsors, executives, as well as the regulators who have helped police this industry in a soft touch, light touch sort of way. So it's been professionally quite satisfying.
Yeah, I can imagine, because I tell people, when I introduce what I do to other attorneys, I don't know if you get the same response, but I say I'm a securities attorney, and I get this sort of strange look from either other attorneys, because they're not quite sure what I do. And I specifically chose this area of law because it's just so fascinating to me, particularly because there's a political component to it. It's very policy based, right? But also, particularly here in Georgia, we have a strong technology ecosystem. So I get to go to all these programs and pitches, and I get to hear from these entrepreneurs about ideas. You're like, why didn't I think of that? So it's just energizing to see people coming up with these ideas, me being able to counsel them about what their options are, and to see something birth like a baby from start to finish. And to hear these success stories is just amazing. I am a fan of ABC's Shark Tank. That probably doesn't surprise you. But I always love the stories of the entrepreneurs going into the Shark Tank, and for whatever reason, they don't get a deal. Maybe they devalued them, or they just couldn't come to terms. And then you hear about them a year or two later, and now their value has skyrocketed beyond what was the valuation when they were in the Shark Tank, and they're raising money on crowdfunding platforms to prove it. And I just love those types of stories, because I think it is a great equalizer. Like you said, it's not those traditional go into closed rooms, only certain people are invited type of deals, where you get a deal before you leave the room, or you're not going to get a deal. Entrepreneurs now have that choice to say, if you won't give me a deal, I can go to a whole nother market and make my pitch and see if I can raise money that way. So it's a fascinating area of law, I think, to really be in. You've been doing it a lot longer than me, so I'm sure your energy level about what is happening, particularly getting involved, just brings a smile to your face. And this really is affecting business owners on a daily basis. So that's got to be very, very rewarding for you.
Oh, it is incredibly. Well, no different than watching some of the entrepreneurs execute beautifully and have their deals become successful and employ people and make investors money. What you're doing, what I'm doing, what the CfPA is doing, and Scott, is we are trying to facilitate a more efficient capital formation process for entrepreneurs that historically have been left out of that process. And we've done that. It's incredibly powerful. And all the platforms have proven out the concept that Crowdfund Capital Advisors had put the wheels in motion in 2011 with Sherwood Neese and Jason Best, and this whole group of people who spent the next several years, and in many cases worldwide, to work with the worldwide crowdfunding industry. And so to see the vision come through is quite special. And you don't have to think of yourself just as a securities lawyer anymore. You're an interesting securities lawyer who helps entrepreneurs, and everybody will find that around the barbecue interesting.
Well, I will try that at my next cookout, definitely, for sure. But one of the things that I'm always interested in hearing from other people that do the type of work that I do is, what do you say to some people? You've already given me your response to people who say there's going to be rampant fraud, right? If you have this type of vehicle, there's going to be rampant fraud. What do you say to people who are worried that maybe people are going to lose their money, that grandma is going to take her and invest it into a crowdfunding project, and she's gonna lose all her money? Because that's a lot of what I get is the SEC has been people, and it was after the Great Depression, right? We all know that, but things evolve. So do you have a standard argument you can help me with about grandma not going to lose all her savings because she invests in a crowdfunding project? I mean, of course, anybody can lose an investment. I understand that, but this notion that every grandma is going to lose their pension if we create this type of platform.
Yeah, I know. I appreciate your asking me the question. The truth be told, we had an answer. 2021, our views on that issue have been proved to be truthful, whereas regulatory and investor advocacy concerns were greatly exaggerated. The results are in, and that isn't the case. That doesn't mean that there aren't individual instances where grandma or grandpa have lost a little bit of money, because remember, in reg crowdfunding anyway, you have money that people are allowed to invest. And I think there was wisdom in that. There were a lot of libertarians who didn't like that there was any cap whatsoever Our federal securities laws are based on the premise, if I give you full and fair disclosure, you can lose whatever money. Our regulations very often impose what we call a merit review on top of what otherwise is supposed to be just a disclosure-based system. We impose on our broker dealers that they know their customers, and consequently, what we've done in crowdfunding to prove out the use case was limit the amount of what that loss might be, so grandma and grandpa wouldn't become a ward of the state. So I don't think that that's a realistic concern. I think the use of fraud by federal and state regulators as a way to deter and slow down the evolution of the crowdfunding industry actually was to a detriment of the US capital markets, because in the end, you're going to have statistical amount of problems. You have that in the public markets, you have that in the private markets, and you're going to have it in crowdfunding. More realistically, you're going to have significant losses, not through fraud, but through failure. And that
disclosure, and there's nothing wrong with that.
So I think it's a balance, and I think in crowdfunding, we hit the proper balance with having the crowdfunding platforms properly regulated by FINRA and limiting the amount of money that the companies could raise. I'm excited that it's increased from $1 million to $5 million, and I'm glad that accredited investors are not capped the same way that retail investors are. So overall, I think we've hit the proper balance, and it's working. And I think we should do everything we can to keep improving it.
Darshan, Douglas,
Absolutely.
I just wanted to point out. My apologies. I just wanted to point out that we have a Q&A question lineup over there. So if any of these questions speak to you, yeah.
Well, yeah, Peter, I saw there was a question about, are most of the investors in crowdfunding retail investors? And the answer is yes, but there's an increasing amount of institutional presence in these deals. And I think the SPVs will go a long way to further that. And I would suspect that 10 years from now, the balance is going to be really healthy, that you'll have institutions leading, investors participating, which was always the holy grail of the structure.
And we have some questions in the Q&A chat, so I'll just read them out. The first question says, where do you see the biggest proximate opportunities for crowdfunding opportunities, Main Street capital formation, startups, introduction of co-investing with institutional investors? I mean, I work in startups, so it's always startups.
Yeah, why don't you take a crack at answering that, Darshan? I'd like to hear your answer.
Yeah, I work with, well, let me say, I work with startups, but I also work with companies who are not startups, who are growing and want to grow and scale. So the biggest opportunities for crowdfunding, I unfortunately going to give the lawyer answer and say it really just depends. Some markets are hotter than others. Some industries are hotter than others. The timing can depend on it. So for me, I see a lot of startups and growing companies that are taking advantage of the crowdfunding opportunities. I have not seen any sort of companies so far that have partnered with institutional investors in order to do a crowdfunding venture. So I guess I might be in a different market, but Douglas, you?
Well, what I'd point out is, since there are several different provisions to the Jobs Act, that's certainly true as it relates to Title III reg crowdfunding.
Or plus, as it were. Those, I think the jury's out as to how those exemptions will be utilized.
Certainly within 506C for hedge funds, it's very institutionally oriented. So it varies depending on the exemption. Reg A Plus was always thought it was going to be mostly an institutional investor base. I think, it's going to end up being utilized mostly by the brokerage industry in the end as an alternative to S1s. Maybe it'll be a little bit like a mini direct listing with some institutional participation. as well as the distribution in reg crowdfunding is across all 50 states, but the highest frequency of use or the concentration is in the usual states: New York, California, Texas, I think Florida, but I think every state has had financings at this point in time. So let's see if I can find a question for you. What is your advice on investors in terms of valuing these startups, since their financial statements are not very informative? Is it the team, the industry, other? So this is a question on valuation. Do you have a point of view on that?
I do. I actually have an MBA, so I work with financial documents all the time. Although I specifically went to law school to avoid finances, but here we are. And so obviously, if you are pre-revenue, what we call pre-revenue, and you don't have any financial statements, or the financial statements aren't that very much long term, you're right. A lot of it is going to depend on what type of industry you're in. Obviously, if you're a serial entrepreneur and you've already proven yourself and this is your 8th business, then obviously you're going to have more value that's going to be put into your business. But a lot of times what people will do to have sort of a starting point for the valuation of their company is they will look at the data, right? Data always helps us with the numbers. And so they'll look at the size of the industry, they'll look at their geographic location, they'll look at their specific niche, what makes them different, and sort of try to narrow down that big number of, if it's $1 billion industry, and narrow it down to something that is more specific to where they are. If you have any financial projections, that's why pro forma statements are so very important. If you can project out for 1 year of cash flow, even though you're pre-revenue, then the typical rule of thumb is to do 3 times the cash flow that you've projected for 1 year. But again, you have to actually make those projections, right? So there are a number of different ways that you can do pre-revenue valuation. It's just about a number of different factors. So hopefully those couple of ways that I gave you will be a good starting point. But it is definitely a mix of, in my experience, science and sort of magic as to how you get to that valuation.
Right, but I think the one thing that, and since this is somewhat of an investment advisory conversation, people need to be mindful of is the valuations are picked by the targets. The way the rules were written is that the staff at the SEC did not want the platforms, unless they're a broker dealer, to give investment advice. So they're really very careful not to help establish the valuation. So you need to be very careful. But that's also true in the public markets. You look at all the pre-revenue deals that are going public, and it's very hard to justify some of the valuations, or at least understand how to come into market at those numbers. Sorry, Peter.
No, it's all good. I wanted to give you a chance to wrap up, but our next panel is coming up. You want to do the kind of a closing remarks here?
It's just been nice. I have learned so much from Douglas. So thank you for allowing me to be on this panel and just to chat with somebody who has been active in the space that I love and has a lot of experience. So thank you.
Yep.
Very proud of what the CfPA is doing. Darshan, pleasure to meet you, and congratulations to everybody who's been utilizing the various Jobs Act exemptions in an appropriate and productive manner.
Thank you both. It's been really wonderful to listen to you, and it was interesting to hear that it was. I didn't know that Georgia had even the ability to raise before all the other states like that. So that you live to learn. All right. Well, so for our next panel, thank you very much, guys. I will ask. Let's take a look. Steven Sinelli, Brian Korn, Naveen Tukaram, and Suju McIntyre to join us. Suju will be the moderator for the panel, and hopefully we'll see also Naveen joining us in a second. This discussion is labeled Connecting Institutional Capital and Crowdfunding. Originally, we aimed to talk about specifically VC influence, but since the exits are predicated on not just on VCs, we thought to take it straight to institutional capital. So Naveen, waiting for you now.
Peter, do you want me to get started? There we go. So we're all here. Thank you, gentlemen. So we topic today: crowdfunding, institutional capital and crowdfunding. We have a extremely impressive group of panelists here. I'm very pleased and appreciate the chance to moderate. I'll try to do brief introductions, and I probably won't do you guys justice. So you can introduce yourselves as you like when as you begin to speak. I'll start with Stephen Chinelli, creative strategist, banker, and business advisor with a very strong background in private equity and capital markets. Was the founder of the first crowdfunding platform in history back in 2000, called Off-Road Capital. And Steve and I had a chat earlier before we came on, and he was telling me about the work that he's done there, and it's very impressive. I think it's going to contribute quite a bit to this discussion. We have Brian Korn, who is an attorney by trade, also with a strong background in capital markets, both from the investment side and I believe in the compliance side of the business for Barclays Capital. So I think Brian is going to contribute quite a bit on the legal side, in addition to the capital raising side of this conversation. And we have Naveen Tukaram, who is a lead investor in Skykick, which is a software as a service platform for cloud business models. And Naveen also has a strong background in venture capital, equity investment. These panelists, I believe, have deep experience with technology at all stages. So I know we don't have a lot of time. I'm gonna try to go right into the discussion. So with regards to institutional capital, and it was very interesting to hear Douglas Alanoff say earlier that make reference to the Holy Grail being reaching a point where institutions are leading crowdfunding rounds, and that certainly would be a great to see crowdfunding unfold and to see institutional equity come into this. Maybe a good way to approach the discussion is to think of why doesn't that happen now today, and how can we get to that point? What would you guys as institutional investors like to see change in the environment? Maybe the minimum deal sizes being increased, maybe changes in the way that the platforms are operated, and maybe changes in the way that the governance mechanisms that are present at the time that these offerings come to market have been shaped in advance. One of the things that always is clear is that institutional investment is a result of process, and investment committees designing a process around crowdfunding. I didn't know until I chatted with Stephen earlier the exact depth at which institutions have already taken steps to formulate crowdfunding strategies, which is terrific. And so maybe that's also a topic that you guys can each touch on, is from your point of view, if your investment committees ask you to formulate a process and strategy for crowdfunding as you see it today and as you see it evolving, what might that look like? What kinds of things would you like to capture in the process? If that's a decent enough start to get started, I'll suggest Stephen go first, because I did chat with him about this stuff earlier.
Okay,
so.
sure. And by the way, hi Brian.
Hey Steve, how are you?
Good. How are you? There's a little feedback. I guess we got it locked. What we were talking about early on is, I guess, the observation that the institutions really haven't played much in the space, largely because I think economies of scale, transaction sizes were relatively small. Institutions like to put more capital to work. They like better control. a variety of reasons why the big guys haven't jumped in. That being said, there are cases where institutions see crowdfunding actually in a positive light, particularly when it comes to impact investing. There's a number of platforms that do receive institutional support as an institutional investor is trying to build a portfolio in social impactful things. The investment thesis is a little different. They're looking to expose themselves in a lot of ESG type stuff. And so there has been some, some demonstrable activity there. There's also examples of big institutions. There's one that I read just the other day, Aegon, which is a large insurance company out of Europe. They actually committed, and they were trying to push their initiative for small business, SMEs and whatnot. And they committed about $1.6 billion to crowdfunding investments, small business loans, to make a statement. So that was, a interesting exception to the rule. But for the most part, I think the challenge with institutions is that the size of the transactions, have been relatively small. Now that they've bumped the transaction size from 1 to 5, where it's maybe a more full up Series A or possibly a Series B, maybe that's going to attract some attention. But that's my first comment. I'll allow the other gentleman to chime in.
All right, sounds good. That's probably best as everybody table their. We'll see what we can do from there. Just randomly, Naveen, do you want to go next? I think you're on.
Sure, happy to do it. Good morning, everyone, or good afternoon, depending on where you are. You guys can hear me? Yes, no, maybe? Okay, good.
Yes.
So,
yes.
Little background on me to give, I think, context is always king on these kind of panels to see where people are coming from, where the perspective is. My background is primarily in private equity on one side and also in investing on the other extreme. I've sold about $3 billion of companies, and the companies that I've been on the board or close advisor to have raised on the startup side about $150 million, primarily from about $4 million, as I recall, came from crowdfunding. One of my companies, Mendy, which I'm an angel in, just raised $3 million in late 2020 on Kickstarter, which was one of the best Kickstarter campaigns, I guess, in Europe ever. So definitely a big fan of crowdfunding when I think it fits with the type of company that is raising the capital. To answer your question directly in terms of what do I think can change in crowdfunding in terms of the rules, regulation, incentives that would allow it to explode a little faster. I mean, I think that the SPAC phenomenon has shown us that if you incentivize institutions properly, I'm not sure if what they're doing is proper, but if you incentivize institutions in such a way that they're going to make money, you can basically see a market explode from what it seems like was overnight, even though SPACs have been around forever. The way folks like Chamath and many, many others are using the SPAC model to make themselves quite a bit of money, a little bit decoupled from how well their SPACs do, has allowed that, I don't know how many billions of dollars of SPACs. I wish I had that number on the tip of my tongue, but that's shown us that when you incentivize institutions in a certain way, things can change very, very quickly. I mean, the hardest business models out there, or among the hardest business models out there, are always, in my mind, two-sided marketplaces, right? Because you got to get two people to do things that are in their individual interest to make it happen. So you need good deals, and you need capital providers that want to invest capital in those deals. And in my view, quite simply, the best deals are not going to the crowdfunding marketplace, right? I mean, if you're an entrepreneur raising money, which a lot of my guys and girls, I should say, you're not going to crowdfunding as your first stop. You're going to your personal network, you're going to your professional network, then you're going to well-known angel investors, you're going to well-known early stage funds that focus on, super angel type level investing. You're not going to the crowdfunding platforms to get funded for the most part. So I think number one, when the best deals are going to, or at least good deals, great deals are going to crowdfunding platforms, then you're going to see a lot more investors pay attention. And second, you have to have, like I think Steve said, you have to have, folks being able to actually invest real dollars, right, in those deals on the platforms. You can only invest, if you're an institution, you can only invest, $100,000 to $200,000, $300,000, and you got to do all the work on the crowdfunding and you're competing with others on it. I mean, like, that's not nearly as interesting. And it doesn't really move the needle in terms of their carried interest over time to get them to want to invest time, in crowdfunded deals. In addition to the fact that, they're in theory not finding the best deals on those platforms. So I think both has to happen, which is that you need to have better deals arrive on the platforms, and you have, from the capital provider side, people need to be basically be able to pay for their time in terms of being able to invest real capital on those platforms.
Sense. We'll go. Those are great points to come back to. I want to give Brian a chance to weigh into this conversation with his input, and then we'll go.
Thanks. I think that there are a couple of things at work here. One, let's talk about what we're talking about when we say institutions. We're talking about professional money managers that manage a lot of capital. That can be large family offices, be pension funds, it can be hedge funds, it can be other groups. All of those have very different investment goals. You can't categorize institutions and say, why aren't institutions crowdfunding? Well, if you manage retirement assets, you have a fiduciary obligation to use prudence, and very often crowdfunding assets don't meet the suitability guidelines for putting pension funds and other types of ERISA plan assets to work. And so that group is kind of out of the crowdfunding game. Hedge funds thrive on liquidity and thrive. These are all illiquid investments. They're pre-trading, pre-IPO. The time horizon there is them, and so you're not going to see hedge funds. That leaves private equity, and it leaves VC. There was a little bit of a talk at the beginning of crowdfunding that VC and the crowdfunding industry would be at odds with each other, because if you think about a startup, the paths one could take, one could go down a road with a venture fund, get seed capital, Series A, Series B, and so on, or they could go through the crowdfunding process and receive lots of money from several different sources. And VCs obviously are very proud people. They don't want to be last in on a deal and get the worst terms. And so the thought was, well, they're not going to really want to invest in a balance sheet that's way overcrowded by a bunch of crowdfunding early stage investors. That paradigm has shifted a bit, and we are seeing a lot of interest in crowdfunding. A lot of VCs tell startups, try and do a crowdfunding round. Let's beta test this. Let's see if it has resonance within the crowdfund community.
Brian, that's probably a good time to sort of move on, because the time's going by fast. Naveen, an interesting, so picking up on those 2 points that you brought up, it seems to me that bringing in better deals and bringing in more suitable investors, that's a responsibility that would fall squarely on the platform itself, right?
Mhm.
Would you agree? What kinds
Well,
of things do you see?
it would certainly help them by getting more people on their platform with the better deals. No question about that.
Yeah, I mean, I think at the end of the day, that's their business model. One of the platforms are a business in themselves that are trying to presumably generate fee revenue, I would guess.
Well, maybe I can interject here.
Okay.
One observation I've had with the crowdfunding model. So I founded the first of the platform finance companies back in 2000. This, crowdfunding was not a term of art. But one of the things that we did was every single deal that we took to our market of about 14,000 investors, and our average size was between 3 and 15 million. Every single deal got done. The problem you have with the crowdfunding platforms is that they're really marketplaces, they're menus. You've got a lot of noise on most of these platforms trying to elevate, a particular transaction to get exposure with the right investors. Again, maybe I'm broadly speaking, but I think there's a fundamental problem with the crowdfunding model. I was talking to Suju earlier, is that it's interesting that crowdfunding and, they generate fees, both from transactions and maybe from some, ancillary services, but there really hasn't been a series of strategic acquisitions of these platforms by institutional investors, by private equity firms, by investment houses, whatever. And so that to me suggests that something's wrong with the model. You look at Goldman Sachs when they wanted to do or move into the peer-to-peer lending space, the consumer lending space. They have a lot of money. They could have bought Lending Club. They could have bought Prosper. Neither of those they opted for. They built Marcus internally. So I ask, and I'd love to get everybody's reaction. Is there, essential value being created by these platforms whereby they become of strategic interest to some acquirer?
Well, I'm going to table this thought here. Early in my career, one of the experiences I had as a junior investment banking analyst was working on the Instinet bond trading platform deal, which was owned by Reuters, and the bond dealers complained that the platform wasn't meeting their needs. And the solution that got tabled and eventually implemented was for the dealers themselves to buy the platform. So the bond dealers, is very interesting. It was a combination of a fixed ownership that they got, and then there was an adjustment based on the volume of bonds that they traded on the platform. So they ended up with a combination of ownership that if you were more active in trading bonds on the platform, you ended up with a greater ownership of the platform. And therefore you got a greater portion of the fees that you essentially you got a fee rebate on the trading fees that you were paying to the platform. So it makes me wonder, would there be any legs to that sort of idea? Could somebody organize an institutionally owned crowdfunding platform where the ownership was a function of the volume that they ended up doing partly on the deals, a two-tier? And I just table that as a concept because I want to go back to the idea that you want to bring investors to the platform, and that's presumably it's a chicken and egg. If you bring higher quality investors to the platform, you're going to get higher quality deals raising money on the platform. And if you brought a group of brand name family offices even that decided to join together in a consortium and establish a platform, I would think that would bring higher quality entrepreneurs and opportunities to the platform. So I'll just leave that with you guys to maybe bounce around, because I think we've kind of got to the point where the platform is the focus. So that's good. We've got to focus.
Yeah, I think you're absolutely right on that. In terms of higher quality deals would lead to, I mean, it is a chicken and egg thing. I'm not sure if family offices are the right folks, given the risk aversion of a lot of those folks to be. But your point is well taken in terms of it's really just a matter of getting that critical mass of capital interest capital, on the platform. So folks want to show up. And I mean, look, in my view, for the most part, I recommend entrepreneurs to go a crowdfunding direction when they sort of have a D2C component to their business, right? Like I wouldn't have a cloud infrastructure play, a B2B cloud infrastructure play go on a crowdfunding. People aren't going to understand it. But if I want to have a backpack that has like pockets for, my cell phone charger where people can really understand it from a 2-minute video, then yeah, I would say go ahead and do that. Mendy, again, one company I'm an investor in that we did 3 million euros in crowdfunding on Indiegogo and Kickstarter last year, so hugely successful. It's a brain training app, so it's like a headband essentially. It looks like Apple made it, that helps you improve blood flow to your frontal cortex and has all sorts of mental health benefits. So people could get their heads around that, pun intended, on the crowdfunding platform, and that was a great example. But 8 years ago, would I have put Skykick on crowdfunding, a B2B platform for cloud migration and AI-based automation? No, because the investors on the platform would have no clue what that would be, and it would be very hard for us to explain it in a 3-minute gimmicky video. So it also, I think there's a place for it for certain types of assets, and for other types of assets that need more capital and a different, more sophisticated level investor, that's just not the direction they're going to go. So I think from a ecosystem perspective, it needs to figure out where it's best delivering value and focus on bringing critical mass in that direction.
So going back to Brian's point, I know, so Brian, I'll turn it over to you in a sec, but he pointed out quite aptly that there are different institutional investors, not a generic beast. There are many types, and they would have different needs. And to Naveen's point, you have certain platforms that are going to be more amenable to the needs of different types of investors. I would imagine some of them are interested in looking at crowdfunding as sort of an innovation pipeline, the way that corporate accelerators function for large companies, as an example. So Brian, maybe do you want to pick up on different types and how?
Yeah,
go ahead.
No, I agree. I think that proof of concept, proof of customer, many investors want to see how the crowd will react. One thing to think about, a lot of the crowdfunding entrepreneurs are not interested in granting board seats, observer rights, or having an investor representative parked in the office next door. And when you do take money from an Apollo, that's exactly what happens. You're spending half the day with them. Forget about being second guessed. Everything you do is virtually guided by your institution. And if they don't like the direction that things are going, then that's a problem. And so crowdfunding allows you to have more independence, because you're able to take money from people who are not going to have corporate governance rights. And that's a major consideration for a lot of investors. You're also able to take an investment where the crowdfunders don't have preemptive rights to keep investing in the next round in a way that might hurt your ability to raise capital. But on your first point, I agree with you, Suju. There is a sense out there that if you can raise it from the crowd, that maybe you're onto something and maybe it's a viable idea. And there are obviously a lot more tales of failure than of success.
Yeah. Stephen, do you want to
just to echo Naveen, one of the observations I've had, and I think most people have had, is the successful crowdfunding campaigns are typically consumer products, something that touch and feel, that you can market, and so on and so forth. And what the crowd does is not only provide investment capital, but basically proof of thought, proof of demand for that particular product, which is great. It creates a buzz. It can leverage things further. When you have your earlier company, which is a cloud-based solution, yeah, that's a little heady, and you're probably not going to have a lot of success. One of the crowd platforms that's done quite well in focusing on the consumer area is Circle Up. Circle Up, they ended up putting together partnerships with a number of big consumer product companies, and they look at what's teed up, and they provide investment capital. So they've forged a really interesting relationship with institutional investors, corporates, I should say corporates specifically, that have interest in various CPG spaces. So, so that's my 2 cents.
All right. Well, I think we've got 3 minutes left, so let me go around and to each of you one takeaway for all the participants watching, if they wanted to, if they're out there and they would like to try to attract trying to get to that goal of someday institutions will lead crowdfunding. So if you're an entrepreneur and you would like to dream about having an institution be alongside you and lead a crowdfund, what advice would you guys give them? You got 2 minutes. Go ahead.
I'll just say, as an entrepreneur, you want to make sure that you match your capital needs with your investor. So like Brian articulated, if you want, a few $100,000 and you want folks that don't have a lot of governance rights, et cetera, maybe crowdfunding is a good first step. And also if you have a D2C or B2C play that's tangible, like Steve mentioned, then it could be great to go a crowdfunding way. If you need something different, then maybe you need to go to a family office or an angel investor or venture capital, but understand what kind of capital you need and make sure you match your capital provider with the kind of capital you need for your business.
Yep. Makes sense.
I
Brian?
think my final thought is the crowdfunding honeymoon period is over. The novelty of being able to crowdfund we're past that. And the deals are still sold by the entrepreneurs. You can't go to a crowdfunding platform and expect it to jump off the page. You have to create that buzz. You have to be able to market and push it. And it is what you make of it. And at some point it'll take off or it won't. And you have to realize criticism. And if the market doesn't like something, there's usually a reason. And don't be afraid to fail, because that's what ultimately leads to success.
Yeah. Stephen, do you want to?
Yeah, one sort of curveball comment about trying to enlist corporate investors. One of the things that I guess this particular summit is not only about assessing what's transpired in crowdfunding over the last year and some of the successes and so on and so forth, but where does it go from here? And I think that one thing that dawned on me is that with the new administration and the tax regime that they're looking to apply in terms of capital gains tax, carried interest, so on and so forth, I think that this is an opportunity for the crowdfunding community to possibly go back, talk to McHenry, talk to some of the people on the Hill about, could there be some tax incentives for folks to come in and invest in small businesses through crowdfunding platforms? I've done a lot of ESOP work, and Louis Kelso, who developed the ESOP back in the 1950s, late 1950s, they were really tax driven. There were tax benefits associated with the company, to the lender for lending for ESOP purposes, for sellers of companies into an ESOP company. Tremendous tax. There's a lot of tax incentives, and I think this could be an interesting opportunity to be smart and be creative to create a new a new chapter for crowdfunding. So
yeah. Well, that picks up on it would be nice if we had more time. Oh, there's Peter. So Naveen made the point of having to incentivize people the way that happened in SPACs, and that's a great comparison. That's a good topic for everyone in crowdfunding to kind of ponder further, is how can you replicate the success that they had with SPACs and getting this flood of capital in. Taxes are an incentive, discounts to market, and entry at discount to market is an incentive. But we're out of time. Thanks, Peter. This was great. Thank you very much.
I appreciate you all joining. This was great.
Thanks, guys.
Thanks, guys.
Appreciate it.
All right.
Yeah, that was great.
Allow me to now introduce Rob Salvador, founder of DigiBuild, who is also a sponsor of our conference. So thank you very much, Rob. And in the panel for discussing fintech and real estate, Naveen, let me take you down as well. And okay, 1 second. Here's Rob. Awesome. And our second speaker is Adam Gower, who is an experienced commercial real estate fundraising expert. So Adam, allow me to bring you up as well. Adam, just turn on your camera and microphone. Hey, Rob, how's it going?
Hey.
All right.
Hey, Adam. Hey, Peter.
All right,
Nice to see you guys.
start now. The conference can start now. We're here.
Uh-huh. Yeah, exactly. All right, fellas.
I've
Well,
got my
I'll let you
water
have
too.
it.
All right, good.
Whiteboards now.
Peter disappeared, so it's up to you and me now.
Just you and me, Adam. Can you hear me okay?
Huh?
Can you hear me okay?
I can hear you just fine.
Perfect,
What
perfect.
are we talking about? Boomf.
Well, I think we can start with maybe the role of fintech over the last year and how it might have changed, and how things like crowdfunding might play into fintech. Both how things have changed over the last year or so with COVID and whatnot, and maybe some trends that we see in the future. And then we can talk about maybe real estate after that. I know that I believe those were the main two topics. So
Okay.
want to start it, Adam? Go ahead. You can start with fintech, and then I'll pick it up after you.
All right. So I'll tell you what, Rob. Fintech is not my area of expertise.
Okay.
My area of expertise is real estate crowdfunding, how crowdfunding has fundamentally changed capital formation in the real estate industry. That's definitely what I can.
Okay. Yeah, let's start with that then. Yeah, that's fine. Let's start with that. We can go real estate.
I don't know how much that actually dovetails into fintech. All right.
I think they're all interconnected. And I think, when we talk a little bit about the impacts on the real estate sector, we can maybe touch on some of the downstream things that have happened. I come from the construction industry. We build construction software. We're actually doing a crowdfund right now. So that's how I came to be here at the panel. So I think what we can do is kind of dovetail into, how has real estate been affected? What are the downstream, implications to construction? And then how is fintech playing into both of those in kind of this new paradigm? So why don't we start with commercial real estate and real estate in your area of expertise, and I'll jump on after that.
And not actually being able to multitask very well. I am keeping an eye on the chat, and I noticed that Scott McIntyre actually hit the nail on the head. And that is that, what is fintech? What is tech as it applies to anything really, particularly crowdfunding? Tech really is nothing more than a staid, ancient industry, staid, old-fashioned, ancient industry adopting the use of this device. That's really all it's about. There's really nothing else. So whether it's a sophisticated construction system or using the internet, using the phone and computer and using social media to attract investor prospects and to attract investors and convert them into being prospects, that's all part of tech. And as far as crowdfunding is concerned, tech was never really, there was no incentive to use tech in the real estate industry when it came to capital formation, because you had to have a pre-existing relationship with a prospect before you can meet them. And if you've got a pre-existing relationship, you're gonna meet them, right? That's how people did it. You couldn't advertise, you couldn't use social media, your website really couldn't do much more than be a glorified business card, right? But now, with the opportunity to raise capital online, to crowdfund your deals, sponsors who are not used to it are actually rapidly coming into the industry and adopting crowdfunding at the same rate as they adopt tech in any way at all.
Yeah, no, absolutely. And I think one of the key points that you're seeing, many markets, especially real estate and capital formation in real estate, is what I always say, the internet finding the power of itself. And I guess the biggest example that you can talk about is, everything that's happened with Wall Street bets and, GameStop and AMC. Like you said, for many years, in order to get traditional loans or, project financing for a new development, or even to sell a piece of commercial real estate, like you said, you kind of have to have these relationships or specialized businesses that, do those things. And while those businesses are still very relevant, to your point, when you have, 6-7 billion people around the globe, all of whom, I think the statistics are only something like 30% of people are still unbanked, but 98 or 95% of people have cell phones around the world, talking even third world countries and things like that. So when you look at just how many people are out there with the power to invest at their fingertips, it was kind of only the next rational step in utilizing the internet and to utilize, those big groups of people for really anything. You can talk about tokenizing a piece of real estate, which is something that's happening. You can talk about, straight crowdfunding real estate, which you see on a lot of sites right now. I think I've seen, at least on Republic, the site that I use the most, I think there's 3 or 4 different major infrastructure projects, like even a apartment down in Miami, I think in Brickell, that is crowdfunding right now. So you're really seeing, I think, what is a new paradigm of peer-to-peer everything, peer-to-peer lending, peer-to-peer real estate, things like that. And at the end of the day, it's, why would you discount the 6-7 billion people out there, who can participate in, real estate or getting involved in some sort of real estate, who may not be able to have done that in the past? So I really think that not only is it the future of commercial real estate, but like some people, like you were just saying, and like kind of some people in the chat are mentioning, it's a good way to put it. It's not a one-to-one communication pathway anymore. It is now, we're all interconnected. One other example I'll talk about before we can, I'll get back to you, is, just look at how difficult it is if you want to get a loan right now for real estate development or, for something in general. There's a lot of things that go through it. And that's because, a bank, they have risk assessments and things that they have to do. And they have capital partners and they have controls that they have to put on their capital. But maybe that, maybe there's 10 banks and none of them will give you the loan you want. But I promise you that somewhere out there in the vast world of the internet, there's 2,000 people, each of whom would give you $1,000, right? And that's in their risk, preference. They're okay with it. And boom, now you have your funding for your, real estate project. So I think crowdfunding really opens up a lot of new possibilities across multiple different markets. And Adam, I'd love to see any or hear any examples that you might have that you're seeing out there, or good stories that you have to kind of go with that.
All right. So when I look over here, I'm not being rude or anything. I'm not like doing emails or sending texts or anything. I'm looking at some charts that we've been doing. So we have, first of all, let me just contextualize what it is that I do. And I came into the tail end of the last conversation, and I've seen the agenda for the next, for this conference. I just want to be clear the sector of crowdfunding that I'm involved in. I am involved exclusively in commercial real estate crowdfunding. Now, it's a term that is used, has negative connotations in commercial real estate. People think that it's donation-based, that it's gimmicky, right? They're used to dealing with sophisticated, knowledgeable, educated investors who they know personally. And the idea of selling their deals, raising money for their deals online in the same way as you might sell this amazing pen, right, is anathema to the way that they are used to doing it, have been used to doing it since 1933. So That's the first thing. I only look at commercial real estate. Now, I don't know what kind of numbers you guys have been talking about, but in terms of crowdfunding and the impact, I know Woody Ness, great guy, we only thank Woody for his work during the run up to the Jobs Act of 2012. So he focuses on regulation crowdfunding, regulation CF, which is what I think a lot of people in this conference are talking about. That is not the focus of my work. There are some very small pieces of commercial real estate that are funded using regulation crowdfunding, Reg CF, and then there are some more significantly larger that use Reg A+. What I've been focusing on recently is the distinction, we're going to get technical, the distinction between Regulation D 506B and 506C. Just for that one guy who's listening that doesn't know the difference, I'll just summarize it briefly. Reg B was the original exemption from the Securities Act, one of the original exemptions from the Securities Act of 1933 that allowed you to raise money from people with, ultra simplified, with whom you had a pre-existing relationship. 2012, as part of the Jobs Act, in which that tiny little piece was Reg CF, there was another piece that was added, and that was 506C. What 506C did was it said, you don't have to have a pre-existing relationship. You can go out, you can advertise, you can do whatever you like online. So we've been looking at that distinction. Anybody using 506C has made a conscious decision that they are going to go beyond their existing network. Now, there's a lot of stuff involved in that. I'm just going to stay straight down the middle of the fairway, right, and not go down any rabbit holes. What I can tell you is that using both Reg B and C in 2020, total of $62 billion was filed with the SEC. Okay, that's strictly real estate. Other people, companies and whatever use these same, but this is these same exemptions, but this is strictly real estate. What is important, profoundly important, and I would like you to know, this is the first time in the history of crowdfunding that anybody is going to hear these data, because we haven't publicized it yet. So exclusive, what's it called? Breaking story on this conference is that we have looked at what happened in 2020. And what happened in 2020? Why was 2020 important for crowdfunding? Through the lens of crowdfunding that I look at it, right, is because it was during a pandemic. It was the first time there was a downturn, right? There was a severe economic hit. And what you saw, what we see, and I'm looking at my chart here, is that using regulation, 506B, the old-fashioned way, the non-crowdfunding way, there was a decline in the number of registrations for real estate capital formation of about 6%. It went down. Crowdfunding, however, over doubled, went from 7 to 15 billion that's strictly real estate in 2020. So it went from being seven? So 7 into what's that? 49, 7, 1/8. So about 12%. Crowdfunding went from being about 12% of the total real estate capital formation industry to being 25% in 20. And so what that demonstrates is the sheer power of crowdfunding and the uptake that sponsors are adopting. They're adopting crowdfunding. They realize that it is an alternative form of capital formation. On the few people that were chatting before, they were talking about institutional capital. What do you need to do to attract institutional capital? My response to that would be, I don't know. Why would you want to? Right? When you can crowdfund. I mean, if you are a huge corporation, sorry, I'll finish this.
No, you're good.
A huge corporation and you need to raise hundreds or billions of dollars, then you've got really no option yet. But if you're not in that rarefied atmosphere of being a huge corporation, crowdfunding is absolutely the best possible option for you. And that doesn't mean WeFunder. That means doing it properly to raise money.
Sure. No, and that's really interesting, talking where we started earlier about how, commercial real estate and financing and capital dovetails into some other markets. So, I come from the construction industry. Obviously, that's what we do at DigiBuild. We build construction software. And, just in new construction starts last year, those were way down. So there's a question in the chat about, is that, the statistics you were talking about, is that equivalent to the general real estate development trends from last year? And I would say yes. There was a major decline in new construction real estate starts. Now, many of them were just pushed back or were delayed. If you remember, there was a lot of uncertainty around stimulus bills and things like that. But I think what you're saying there, makes a lot of sense, because if you have institutional capital that is very risk averse or very much will, make their decisions based on what's happening in the macro market, you have limited options there. There's only, let's just say, let's put a big round number to it. That's a guess. Let's say there's 100,000 institutional real estate developers out there who are building consistently. That could be way off, but just as a round number. Well, you probably have maybe 1 billion people out there who might like to throw into a real estate development individually. So I think there's a lot of potential in, that type of capital formation and benefiting other markets too. When you can fund these projects, it has a lot of downstream effects on, other markets, like I said, construction, and new construction starts. Playing into fintech, what we were talking about earlier. Obviously there's a lot that goes on in intersections in fintech and finance in general, that kind of intersects with commercial real estate and whatnot. So I'm definitely with you there. And I think, what happened last year was not only, it was going to happen anyway, seeing a movement away from kind of big, slow institutional companies doing everything to more of like the internet and the internet hive, or the internet swarm, as some people call it, being able to do things like fund capital projects themselves.
All right. So let me jump in with some feedback on what you said, and also share and maybe in part answer Richard. I can't pronounce your last name, I'm sorry, but Richard's comment on the decrease equivalent to the general real estate development trends. So there's a couple of things I'm going to say. First of all, we are talking about two different types of crowdfunding. Let's be really clear. When you talk about 1 billion people, that you're talking about anyone over the age of 18 with a heartbeat, basically, is allowed to invest in crowdfunding. That is regulation CF, that is non-accredited investors. I only focus on the accredited investor industry, just to be clear. Reg B and C exclusively accredited investors. Reg B does look at non-accredited, but it's minor and diminishing. All right, that's number one. So we're looking at two slightly different things, just to contextualize what I'm telling you. Secondly, here's the key about institutional investors. What happens during downturns is that institutional investors, and somebody on the last one, is his name Brian Korn? Sorry, I'm not sure. I'm not very good with memory with names, but he mentioned corporate governance issues. That's fascinating. What a term. Basically, I always think about it in a different vernacular, and that is essentially, if you have an institutional partner, they are basically going to control everything you do. You are going to be running your project by committee. Anytime you hit a certain threshold of expenditure, or you do something, or your numbers don't quite work, boom, there's going to be a hive of institutional players protecting their investor bases, whoever their investors are, their fiduciary responsibility, and you are not going to have control over what you do. You do with crowdfunding, right? Now, what happens during downturns is that kind of fiduciary responsibility that institutions have to their investors, to their capital base, means that they pull back. So we saw this during the 2008-2009 downturn. Everybody pulled back. All the institutions started pulling back. There was no liquidity, but there was. The problem was there was a dam. The liquidity that existed was exactly what you were just talking about. Individual investors dying to take part in this amazing opportunity to invest in distressed real estate didn't have access. And those that did have access were prohibited by law from contacting those investors. Now that has fundamentally changed. So anybody in commercial real estate, or I suppose anywhere else, but again, my area is only real estate, who wants to raise money and have, importantly, alternative access or alternative paths to capital formation simply has no choice than to crowdfund as well. Even if you're raising money from institutions, that's fine. Go ahead and do that. But you need backup, because during a downturn, those institutions will tell you, we're not investing, no money until we can see what's happening and what's coming down the path, what's coming down the pipe. Individual investors will be all over that, because at that time you'll see prices decreases, time of opportunity. Now, I have something else to tell you about 2020 and exactly what happened. To answer Mark's question, I think is all the way back up the thread now. No idea who asked it. No, Richard's question. I can tell you exactly what happened in 2020 with capital formation, but I'll let you jump in first before I reveal that.
Nice. No, I was just going to talk about, to Peter's question about, real estate capital formation through Reg CF and if it impacts the sorts of projects that are being developed. I'll give my opinion on that, and Adam, you might have thoughts on that too. Personally, I do think so, because a lot of times, if you're a private equity firm, whoever you are, someone considering real estate development, financing and kind of your pro forma and everything from the beginning is going to be something that happens, very early in the development. So I do think you have to be aware of that, because obviously, speaking on my side, I think I'm more the Reg CF side, you can only raise up to 5 million. So, that's still a pretty small amount in relationship to, a commercial build out or a commercial project. So I do think that there is considerations going into that. But I also think, to Adam's point about liquidity and whatnot, raising capital via Reg CF also gives you new options in regards to liquidity, not just now, not just in a downturn, because where, like Adam was saying, a lot of these, big commercial developers, they have risk management principles and things that they have to adhere to during a downturn. But when you're able to start crowdfunding, different investments, and even moving into some of the, what I would call maybe technology of the future that's just starting to kind of rear its head, talking about tokenization of assets, bringing even more liquidity to, imagine having individual shares or individual ownership of a certain section of a major building that you could then, trade or turn into US dollars if you wanted to. It adds a new level of liquidity into previously illiquid, situations. So I definitely think that Reg CF is impacting real estate development capital formation, but I think it's very early. Like I said, you see them here or there, and yeah, to your point, liquidity is everything. And that's why if you look at numbers, right, you can take a subset of institutional investors who get involved specifically in commercial real estate. You've got private equity investors, people like that. And even though there's a lot of them out there, there's a ton of, money in that space, it's still such a small piece compared to all of the capital that's out there in general. Again, going back to what I said earlier about how you have, potentially millions of people who might want to give $1,000, but you don't have millions of, private equity or, REITs or things like that might be wanting to fund these things. So I definitely think liquidity is everything. I agree that marketing is everything. And that's a big thing too, Adam. I think there's, this space right now is getting a lot of attention, especially with the Jobs Act, being expanded, and platforms like WeFunder or Start Engine or Republic really starting to get a lot of traction. So I'll turn it back over to you. I'm curious about your thoughts on liquidity, at least on your end, and the things that you're seeing. Maybe not quite Reg CF, but just in general, what you're seeing in that space as far as liquidity goes and new opportunities for liquidity that may not previously have been there.
All right, so crowdfunding is that new opportunity for liquidity, and that's why this is not tongue-in-cheek when I type out marketing is everything, because there is an intersection between Regulation D, Regulation A+, and Regulation CF, right? They all kind of fit into this crowdfunding bucket. Two of them look at allow for non-accredited investors. One is primarily accredited investors. But the intersection between both of these is marketing. It's as simple as that. It doesn't matter how great your product, if you've got a construction tool and you're raising money on a Reg CF crowdfunding portal, or you've got a 500,000 square foot office tower downtown major city somewhere, you're raising 25 million in equity to buy that thing. It doesn't matter if you don't market, if people don't know you exist because you have no marketing, you are going to get exactly nowhere, right? You're not going to raise a single penny. You are invisible until you make the effort to market yourself. It's the only way. When you talk about crowdfunding, that fundamentally is all you're talking about. All right. So that's really, really critical. It is the intersection between all these different regulations.
And just one other thing to mention there that we didn't get to, I know we're running out of time here, but there are advantages to having, a lot of investors, like a big group of investors, like, 2,000, 5,000 investors behind you, in the ways of getting your name out there for your brand, right? If you have 5,000 people all out there who are investors in, a building or a company, it's easier to get your name out there. Even us, of our investors on Republic, we've had hundreds of people reach out and say, hey, I own a construction company. I own a real estate company. Can I introduce you to the owner to get, your software in there? So I do think in today's day and age where you're seeing, influencers are really becoming the next marketing arm of business. You look at what Tesla's doing, whether you love or hate Elon Musk, he is speaking to his audience or to a platform and moving markets in a way that no one has ever done before. And I think there is a preview of what is going to be happening for businesses. You see it now, the biggest TikTok influencers out there are partnering with startups, are partnering with venture funds, because the internet has brought the world together and has given voices, very powerful voices, to these influencers. So that's another thing I think want to get brought up is, just the ancillary benefits around new customers and speaking to your customers when you have, Reg CF and Reg A type raises and things like that.
Rob, the bottom line is that you have to become an influencer yourself. It's all well and good to look at Elon Musk and Grant Cardone and any of these other people that are, big, impressive presences online. But you have to, I don't mean you, I mean anybody trying to, well, you as well, actually. Like it. Anybody that wants to raise money online needs to be visible. And the way you do that is by having a strong digital presence. Oh my goodness, time is up.
Yes. Easier said than done. Yes. And in order to get famous, you have to have a setup like Peter. He's got the microphone, he's got the headset, he's got the pillow, he's got it all.
Right. So, that's right. Well, the CfPA folks told me that the microphone sucks, so I ordered it over the weekend. Guys, great session. Thank you very much. I hope that you connect afterwards. Rob, I know you have a packed schedule today, so no worries if you got to go. But for everyone in the session, we are going to go into the networking mode, so you can jump between table to table, have a conversation with new people. You'll see that you can kind of click on the on the head of a person and invite them for a chat or set up a meeting with them. Yeah, exactly, just like that.
You're gonna put me crash helmet on. What are you talking about?
This is a very violent commentary here. So yeah, we're and after this, we're gonna be starting the SEC interview with the SEC at 1:15 p.m. That's going to be a conversation with Jennifer Zapralka, Martha Miller, and Sarah Hanks. I think it's going to be fascinating. Stay around. If you have any questions about functionality of Remo, I'm going to be in the room, so holler at me. Thank you, Rob, and thank you, Adam.
Sure. So, Peter, I should just hang out if anyone wants to ask a question.
Well, we're kind of at our times.
Okay. I'm good
yeah,
to
just
go.
hang out in the Remo session. All right.
Thank you, everybody. Thanks, Peter.
Nice to meet you, Rob. Bye.
Thanks, Adam.